Welcome to my channel. I'm Scott, and in this video I'm going to walk you through a process of valuing IBM stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 178 billion market cap, trading at $194 a share, and they have 921 million shares outstanding. IBM operates through the following segments: software, consulting, infrastructure, and financing. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow looks great. It grows from 10 billion to 12 billion. Really good margins, 19%. It was 20% in 2023. Net income is the profit or loss on the income statement. It's revenue minus expenses. That goes up a lot as well, from 4.7 billion to 8.4 billion. Revenue is their sales, which goes up a little bit from 57 billion to 62 billion. Not as much growth as other companies, but they pay a really nice dividend, almost 3.5%, and they could cover that dividend 2 times. It cost them $6 billion, and they generate 12 billion of free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 238 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $212 billion. We divide that by 921 million shares. And we get a calculated stock price of $230. They're trading at $194, so they're trading at a 16% discount. It's a buy according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 59 companies in the same industry as IBM, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, 1.3 billion. The only company that spends more is Fiserv. They're really leveraged. Their debt to equity ratio is 2.5. For every dollar of equity, they have $2.50 of debt. They pay the highest dividend. They've been paying a dividend a really long time, probably before you were born. They generate the most free cash flow, a lot more than Accenture. They rank second in market cap, a little behind Accenture. They're trading at 7 times book value, but their PE is 21, which is pretty good, better than the median average. Really attractive price to free cash flow, 15, one of the better ones on this list. They're trading at 3 times revenue. When I say 3 times revenue, that means their market cap is 3 times their revenue. It's not quite 3 times. It's a little less than 3 times. This is 2.9. They generate a lot of revenue, 62 billion, but their revenue is going down. Their 5-year annual revenue growth rate is negative 4%. That's why the stock is coming down and the yield is going up. Here's their latest income statement, which is really hard to see. Revenue in the second quarter, 7.4 billion, down from 7.6 billion. That's service revenue. Sales revenue, 8.2 billion. That's up from 7.7 billion. So total revenue is up a little bit from 15.5 billion to 15.8 billion. Look at their margin in sales revenue. Expenses 1.6 billion, revenue, sales revenue 8.2 billion, amazing margin. Service revenue not nearly as good, which is surprising. So total expenses 6.8 billion, revenue minus expenses gives you your gross profit 9 billion, up from 8.5 billion. That's their gross profit, 9 billion of gross profit. Let's look at operating expenses. SG&A 4.9 billion, R&D 1.8 billion. So operating expenses 6.7 billion, up from 6.5 billion. So their net income 1.8 billion, up from 1.6 billion. Their EPS is nearly $2, earnings per share. Earnings per share is net income over shares outstanding. So to summarize, I have them trading at a 16% discount. I rank them 7 out of 10, but 5 out of 10 if I would buy them. I don't have the faith in this company long term. They used to be a hot stock, maybe the hottest, but they've fallen way down the chain, and I'm just not sure if they'll ever be back to that status again. In terms of ratios, 8 out of 10, really good price to free cash flow. Financials, 8 out of 10. Their free cash flow is growing nicely, over 12 billion in 2023 and the trailing 12 months. Revenue is not growing as much, but they're doing a great job at managing expenses, which is why they have high free cash flow. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.